Hello, greetings, and welcome to Dividend Blasters. This is our channel's 11th video, and I am so very excited to talk about Dividend Aristocrats. Specifically, I'm going to speak about the S&P 500 Dividend Aristocrats. I'm going to talk a little bit about how they're different than my discussion of the Dividend Kings yesterday, and how they're the same. Disclaimer, I'm not a financial advisor. The purpose of this video is for information and education. It reflects my own personal opinions. Please do your own research and consult a financial advisor prior to making financial decisions. This is what I do, and I've been an investor for over 30 years, but I have a licensed professional financial advisor who I contact before making any and all major investment decisions. It's the prudent thing to do. So, what is a dividend aristocrat? Well, it's a firm that has paid and is currently paying an increasing dividend for at least the last 25 consecutive years. It's a company in the S&P 500 index. That's why I mentioned the S&P 500 dividend aristocrats. They actually came up with this list a number of years ago. Market cap minimum $3 billion and average daily share trading value 5 million for at least 3 consecutive months prior to receiving dividend aristocrat status. The list was started by S&P Global Inc. Used to be McGraw-Hill. There's 43 companies on the list. Sometimes folks get a little confused between the difference between dividend kings and dividend aristocrats. Let me draw a distinction, but also share the similarities. The S&P 500 dividend aristocrats includes any and all companies that have paid an increasing dividend for 25 years or more. When I spoke about the dividend kings, I was talking about companies that had paid consecutive dividends for 50 years or more. Some of those companies are part of this S&P 500 dividend aristocrat list. Some of them that have paid dividends for more than 50 years. Okay. But the dividend king list that I went through, not all of those are S&P 500. So there are different lists out there, and my intention is not to get drawn down into the minutia of this list and that list. The intention here and the objective is to talk about the best dividend paying companies on earth that have done this for an extended period of time. So, but my focus here is just the companies that are at 25 years and above up to 50. Because I covered the ones that were above 50 yesterday, and they were on the S&P 500 as well as many that were not on the S&P 500. Okay, enough said about that. I talked about dividend kings already. All right, let's get to the list, the dividend aristocrats. Okay, so as I said, there's 43 companies on the list. These are S&P 500. Most of them are either traded on the New York Stock Exchange or on the NASDAQ. You are going to recognize a lot of these companies. Now, I did get this list from my trusty resource, the Motley Fool, but I filled in some additional data points leveraging my trusty resource, Seeking Alpha, as well as another trusty resource, TD Ameritrade. What I want to do is to give you a wider aperture and a little bit of a bigger picture of some of the things to look for of some of these winning companies. These are the very best dividend paying companies there are, separate and distinct from the ones that are above 50 years. Okay, we covered those yesterday. So let me explain the table, and it's basically the same table that we had yesterday. I sorted them by basically their streak of consecutive annual dividend increases. So here at the bottom, number 43 is General Dynamics. They have increased their dividend for 25 consecutive years. So they are the new entry to the list, if you will. And you have Church and Dwight, they are 26. So, and so on and so forth. It goes up the list. This is half the list. The next page is the top half of the list. I have dividend classification. Okay, they're all aristocrats. I have the price as of 223. I have the PE ratio. This is helpful because when you want to do a deeper dive, you're going to need to take a look at how the company compares to other companies, particularly like companies, competitors in their sector. We have the dividend yield, which is extremely important because the dividend yield is key to making a decision on whether you're going to invest in a dividend investment. And it's a reflection of the price plus what the investor can expect in payment from the company. You go a couple columns over and you'll see the dividend growth rate. I got both of these because, as you've heard me speak about many times, we need to look at them both in tandem. Ideally, when you're looking at a dividend growth stock, we like to see both of them together aggregating at around 10%. And it's preferred that the yield be smaller than the growth rate. I like to see something 2 to 3%, a little bit more in the yield. I like to see the growth rate 6 to 7%. I want to feel comfortable that the company has a conservative yield that they can handle and that they're not going to cut at any point ever. However, I like to get that reassurance that the growth rate is increasing each and every year. That will give me reassurance. If I see that, I know that the company is growing, it's successful, their revenues are increasing, their profits are increasing, their cash flow is increasing, their debt levels are under control. Those things are important to dividend growth investors. Looking at the two columns in between, the earnings per share, the dividend per share, we want to see the earnings per share clear the dividend per share, and not just by a little. We want to see it clear it easily. That'll give us assurance that they can meet their commitments to the shareholders. The dividend payout ratio, this is very important. It basically is a reflection of the earnings per share over the dividends. I'm sorry, the dividends per share over the earnings per share. We ideally like to see a range of 20 to 60%. I haven't in the past, been a little bit lax where I would say, listen, it's okay if you can go to 70, 75. A couple of times I've gone over 80, but not much. The more I read this and the more I think about this, I'm thinking that I need to be stricter, and I'm going to adopt a posture that's stricter when selecting investments. And I'm going to stick to the 20 to 60% range. In addition to that, so let me just say this. I'm probably not going to go much over 60. Maybe I'll go 65. Coke is a special case. We talked about them yesterday. They were right around 71. And I kind of was thinking, yeah, but it's Coca-Cola. Yeah, it is. And that's a marquee brand. We want to watch it. But not every company is Coca-Cola. Now, having said that, I haven't really spoken much in the past about going below 20%. If the dividend or if the payout ratio is too low, that gives me cause for concern. I'm wondering, why is it so low? Is the dividend yield really low? Is the growth rate really low? What gives? And what are they doing with their profits? Because they're doing something with them. They're not paying them out in dividends. If they are a growth stock, okay, if they are, like a Taiwan Semiconductor or a Nvidia, or let's say they are a gene therapy stock like an Editis or a Beam Therapy, and they are doing research and development to change the world. They're going to go ahead and do a whole bunch of research on gene resequencing and gene therapy that will ultimately be used to extract disease from people's genes. They can come up with let's say they can come up with a routine where they can uh, get rid of Parkinson's or get rid of cancer from somebody's gene. Hey, you know what? That would be fantastic. Don't pay me the dividend. Do the research and development, find out the cure, help humanity, and I'll buy the stock. And a lot of people will buy it, and we will get lots of capital appreciation and make lots of money. And our society will be better as a result. However, if a dividend growth stock has that very low payout ratio, then that's a different story. I'm going to ask questions. I want to know why. So anyway, I just wanted to clear that up. I'm going to hit the list a little bit, um, and I'm going to start at the bottom. General Dynamics, we're all very familiar. It's a very large defense contractor. They're new to this list that I got from the Motley Fool. They have let's see. Their yield is 2.1%. It's not bad, but the dividend growth rate is a healthy, very vibrant 8.45%, 8.49%. That's pretty decent. That's going to clear what I'm going to call from now on the hurdle rate of 10%. So I'm going to adopt that terminology. The hurdle rate of 10%. And the hurdle is the dividend yield and the dividend growth rate together are 10%. So they clear it. That's great. Let's see. Church and Dwight, they're very new to this list as well. They are actually a little under their hurdle rate. They are at about 7.5. So, I would have to ask questions. Why are they not meeting that hurdle rate? Maybe there's good reasons. Maybe they're a consumer staples company. I don't know. I would have to do some research on it. The price isn't bad, but the PE ratio looks a little bit high. Uh, this leads to more questions, and this is healthy to do. This is what we do for all investments. We ask questions. We look at the PE ratio. And we ask, well, how do they compare to their competitors? How do they compare to other companies across larger parts of the sector? How do they compare to like-sized companies, maybe even outside of their sector? These are questions that we ask. The payout ratio is not bad. It's only 35%. So I like that. They're not straining to pay that dividend, and it's not a bad dividend. It's perfectly fine. But as a dividend growth investor, I want to get as much return as I can out of my investment. Next Era Energy, that's another one. That's a utility. I actually covered that last week. They raised their dividend in the 9 to 10% range, and I covered them with Coca-Cola, which went up 4.4%, as well as Louisiana Pacific, the home builder material company, which also went up in the 9 to 10% range. Next Era, it's a decent yield. It's not bad. I like it, but I really love the growth rate of 11.59%. It's pretty damn good. And the payout ratio is under 60%. I like the price, $73. I'd take a closer look at it when looking at the PE ratio and do some comparison analysis. IBM, they got a nice yield, 5%. The dividend growth rate is less. So I'm asking some questions. I like the yield. The payout ratio is kind of high. It's about 73%. So I'd be looking into that a little bit closer. The next two, I'm going to take them both. Realty Income and Essex Property. They're both REITs. One thing you're going to notice immediately is the payout ratios are high. One's 140%, the other one's 200%. So these are not valid metrics to measure a REIT by. Instead, we look at things like funds from operations, which is kind of like a cash flow metric, kind of, and the price per funds from operations, which is kind of like a PP or a PE ratio. Um, you know, those things are good to know. They're not bad. What I really like to look at when I look at REITs, I like to do a little digging, and I like to see what their lease pipeline looks like. How many leases do they have? What's the duration of the leases? I'm a stockholder in Realty Income, and I know for a fact that they've got leases that are extending thousands of them that are extending 15 and 20 years with tenants. Okay, remember, they are a commercial tenant REIT. So they have tenants like Walmart and Target, uh, big stores, and they're going to be paying rent to realty income for years, decades. So, what does that mean for people like us that are investors in realty income? Hey, as long as those stream of rental payments comes in from the tenants, our streams of dividend payments are going to continue to flow, and that is what we want. So, realty income has a nice dividend yield, 4.66%. The growth rate a little under that. It's 3.8%. It's a REIT. This is not a growth stock. It's a dividend growth stock. It's growing. It's not growing by 10%, but the yield is good and it's steady. So you kind of look at the REITs a little differently. Now, I'm going to go up the list a little. I'm not going to cover all these. You can look at these, but you see what I'm looking at. Let's go to Chubb. It's a big insurance company. It's a pricey stock, $208. The yield is kind of low. It's 1.58%. The growth rate is rather low. It's 3.13%. And, the payout ratio is low. Chubb's a big company. They're well respected. But I would ask the question as I'm researching, well, why is the payout ratio so low? Why aren't they increasing the dividend growth rate? Uh, for the time horizon. That's what I would like to see. They clearly have a very manageable payout ratio. So that's a question. Next one is Caterpillar. It's a wonderful equipment company. A little bit pricey, $238 a share. The yield is 2%. That's okay. I mean, the price of the stock is high, so you're going to get $4.80 a year in dividend payments. But what I really, really like is the dividend growth rate of 8.66%. And, my good feeling is reinforced by the low payout ratio. This is telling me that they are meeting their dividend payments, their growing dividend payments easily. Easily. Look at the difference between the earnings per share and the dividends per share. It's 1588 and 480. Outstanding. Outstanding. What's another interesting example here? Well, let's take a look at Roper Technologies. I don't know too much about them, but the price is high. It's 431 a share. The yield is low. It's less than 1%. But per if it's dollarized, it's about $2.75 a year. It's not bad. You have to decide if that's enough to justify that $431 a share. But I would say a compensating factor is the lovely dividend growth rate of 11.69%. There is a question. The payout ratio is low. It's 16.61%. I would have to investigate a little bit more about what they're doing. Roper Technologies, they're a technology company. Are they doing research and development? Are they innovating new technologies and new technological processes? Is that where the profits are going? I hope they are. Otherwise, they need to go to the shareholders. This is just my position as a dividend growth investor. Let's go up to Chevron. Chevron is a wonderful energy company. I am a shareholder. Um, and they just increased their dividend for 2023. It's around 12 cents a share. It went from 592 to 604 annualized. But it's not a cheap stock. It's almost $162 a share. The yield is not. Oh, I'm sorry. The yield is high. It's beautiful. It's 3 point. It's like, wait a minute. I've got that stock. it's higher than 1.83%. My eyes are looking all over the place. It's 3.77% yield. That's a wonderful yield. So you're going to get about $6.04 a share. But I really like that growing dividend growth rate of 5.76. You're going to end up around 9.5% there, almost meeting the hurdle rate. Um, and I like it because they're really one of the leaders in the energy industry. It's them and ExxonMobil, and they're doing this easily. Look at the payout ratio of 30%. Is there room for them to increase? I would think so, but you got to look at these energy companies a little bit differently. We live in a different world where there is some trepidation or hostility to the fossil fuel industry. And they are looking, as I am sure all of these big energy companies are looking at alternative energy sources, how to identify them and build them out and leverage them just in case things change. I will tell you candidly, I don't see fossil fuels going away anytime soon. Our economy is built and underpinned um, by petroleum. It just is. And so we're not going to be able to turn on a dime and all be driving Teslas. It's just not going to happen. That's really one of the reasons why I love Chevron. They've been around a while. They're a growing entity, and they pay a wonderful dividend, and the dividend growth rate is impressive. Clorox, I've got questions on. The payout ratio is high. I don't understand why. It's almost 142%. The earnings per share is not enough to meet the dividend per share. How are they paying that? I can guess that maybe they're digging into cash. I don't know. I'd want to know more. So again, this is part of this whole process of looking at the metrics and asking questions and doing research and digging deeper. And what I'm going to look at is I'm going to look at projections for revenue. I'm going to look at projections for cash flow. I want to know what cash flow is right now. I want to know what the plan is for future dividends for Clorox. Those are the questions that I am asking as a dividend growth investor. T. Rowe Price. This is an absolutely wonderful stock. I have several shares of it. They are headquartered up in Baltimore, Maryland. Um, they have a really healthy dividend yield of 4.35%. You're going to get a nice dividend, a cash dividend, which you're hopefully reinvesting, a little under $5 a share. But look at that dividend growth rate, more than 16%. That's impressive, and they're getting it done, and they're coming in right. They are coming right in under 60%. I wonder if they know about our hurdle rate. They probably do. I think everybody I talk to that is a dividend growth investor, they say 20 to 60, 20 to 60. And I used to say, well, what about no, 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 no. So I'm getting there. I'm really feeling like that needs to be the path forward with a few exceptions. Let's go to the next one. Go to the top half of the list. Uh, let's see. Well, let's take a look at Aflac. We've all seen the Aflac insurance commercials. They're a financials company. They have a decent yield of 2.46%. The price is not bad. Look, the PE ratio looks very, very reasonable. And I love that dividend growth rate of 12.1%. And they're getting this done with a 30% payout ratio. Uh, you know what I would do? I like this. I would probably say, hey, let's take a closer look at Aflac. I would compare them to some of the other financial service companies, insurance companies, see how they do. Um, I saw Chubb on the list. I didn't cover them, but you can take a look at them. Their yield and their growth rate were kind of low. I would take a closer look at Aflac against them, as well as some other financial services companies. Let's move up the list. Look at Sherwin-Williams. Sherwin-Williams that's a pricey stock. We've all painted our house before. The yield is not too high. It's 1.09%. But boy, look at that growth rate. It's over 16%. That's impressive. And the payout ratio is only 27%. So they're meeting our hurdle rate. They're getting it done. Um, I would take a closer look at that. I would like to see I would like to see a bigger dividend yield, especially with that payout ratio. I'd be asking, can you increase it more? Can you increase your dividend yield more? Medtronics, that is a very well respected medical equipment company. Nice yield of 3.2%. I love the growth rate of 8.09%. Um, they're getting it done under 51% payout ratio. And I like the price. The PE ratio is only 16. That price is $84. That looks very affordable to me. But I would take a look at other medical equipment companies and say, hey, is this a good buy? They're very well respected. And you know what? Let me underscore this. These are all dividend aristocrats. These are among the best dividend paying companies on earth that have paid from 25 to 50 years. We covered the ones above 50 years yesterday. Okay, let's take a look above McDonald's. Well, you know what? McDonald's is a pricey stock. The yield is not bad, but the growth rate is very good. And the payout ratio is also good. It's under 60%. I used to be a customer at McDonald's, not so much anymore. Not that I don't want to be, probably because I shouldn't. So anyway, as we get a little older, we get a little heavier. We got to be careful what we eat. All right, let's move up. Walgreens Boots Alliance, that's a good one. I do like the price. It's only $36. A nice yield, 5%. The growth rate's a little less. It's 4%, but it almost meets the hurdle rate. And, I like the price. Um, Walgreens is a nice store. I like going in there. I live right near one. And whenever I go there, they're busy. They have a very loyal customer base. They know how to treat their customers, and I like the selection of merchandise. So that's one of these I will actually speak about firsthand, as I will Lowe's. I live near a Lowe's, and I love Lowe's. I actually um, shop at both Home Depot and Lowe's, but I like Lowe's. I think that their dividend growth rate is absolutely phenomenal. Take a look at that growth rate of 20%. So they got an okay yield of 2.07%, but boy, that growth rate of 20% just blows the hurdle rate that we talked about away. And their payout ratio is only 28%. Uh, I like it. The PE ratio looks reasonable. Um, they must be doing really well because the stock sells for over $200 and the PE ratio is under 15. Con Ed, that is a very, very well regarded utility, one of the most well regarded in the country. I mentioned Next Era Energy as well. They are one of the biggest in Florida, but Con Ed is in the New York metropolitan area, and they have been getting it right for 48 years. I like the yield. It's a decent 3.5% yield. The growth rate is a little bit less, and the payout ratio is a little under 70%. So you know what? They are breaching the 20 to 60 payout ratio. Uh, I would say that folks buy these utilities because they want a steady, stable return. Um, and you're not going to see skyrocketing growth with a utility. You're going to see steady, stable growth. So you need to kind of calibrate your expectations. I look at them and REITs kind of the same way as far, from a growth perspective. So that's how I look at them. Now, the next one, VF Corp, I have shaded. They actually just cut their dividend for the year. So, are they going to remain on the list? Hey, we'll see. They did make the list, but they cut the dividend right after making the list for the year. So, um, anyway, I'm not going to cover them too much because they did cut it, and we can just you know come back to that. But I would say if you're cutting your dividend, that's an indication that maybe there's some problems with your future growth. So just be careful. I do like Walmart. Walmart, I think, is a really good company. I am not crazy about the dividend yield, and I'm not crazy about the growth rate. The payout ratio is less than 36%. Um, but I don't know. I'd have to think about Walmart, whether I'd buy Walmart. I do like to go there. I feel like I get a good deal when I go there. But as far as buying a stock, I'd be looking for a bigger yield. But it's a great company. You know what? They're increasing. They're increasing their yield. I guess what I would like to see is a larger increase on an annual basis. Theirs is 1.89%, on top of the 1.58% dividend yield. So, uh, S&P Global, well, they came up with the Dividend Aristocrat list years ago. They know how it works. Their yield is small and their growth rate is high. So they know what to do. I mean, they own the list. They know what it takes to be on the list. So they're killing the hurdle over 17%. They know what to do, and they're doing it easily. The payout ratio is, uh, what is it, 29.72%. Not bad. And let's go to the top, PepsiCo. PepsiCo, obviously the rival to Coke. They have a decent dividend yield, but boy, I like the growth rate. Dividend yield's 2.6%. The growth rate 7.39%. They meet the hurdle. Now the payout ratio is a little high. Coke's was a little high, a little bit higher actually. Coke's was 71. Pepsi's is about 67%. So I would take a closer look. I'd look at their PE ratio against their competitors, Coke, as well as others, and I'd go from there. So, folks, that's the list. I did some additional analysis, but here it is. I'm going to give it to you really quickly. Um, most of the companies in this list were in a couple of sectors. So if you look at, for instance, consumer staples, 8 of them are in this list. So that's not too shabby. So when you look at consumer staples, you're looking at companies like Church and Dwight and McCormick and Clorox. Well, we have a question about Clorox. Pepsi obviously is a consumer staple. Um, and Brown and Foreman, that's another. So industrials. You know what? Industrials made up the lion's share of the list yesterday, and they're in this one. There's 7 of them here. Roper Technologies, we talked about them. Caterpillar, I love Caterpillar. Um, and I'm just going through my list. Want to make sure that I pick out ones that resonate with you. A company called Cintas, and I'm not too familiar with them, but they're worth investigating. And then financials. Well, we know that T. Rowe Price and Chubb are on there. And Aflac, the financial companies, and there were some healthcare companies on there like West Pharmaceuticals and Cardinal Health. We didn't talk too much about those. I could go on for hours. I don't want to. That's not a productive use of our time. You can read these, but the purpose here is to highlight some of the key ones and bring some um, light to these for you. Medtronic, which is the medical equipment company, which I think is a wonderful investment, is something to consider as well. Utilities, we talked about NextEra Energy and Con Edison. And then there's the consumer discretionary. Well, McDonald's is consumer discretionary. VF Corp, which we talked about, they cut their dividend. They're also, consumer discretionary. I don't know if they're going to remain on here. I don't think they will, but we'll see what S&P Global does. Let's see what is next. I talked about utilities, energy. Well, we talked about Chevron for one. Chevron is the big one. And information technology, well, ADP, automated data processing, that's one. And then the 2 REITs at the end, Essex Properties and Realty Income. Those are them. But most of these are consumer staples and industrials and materials companies. Materials, Sherwin-Williams, for instance. Okay, just a couple observations over the next couple slides, and I'm going to go quickly. There's most of the companies, 22 of them, so more than half, meet or exceed the hurdle rate of 10%. So they know what to do. They know that they have to have that lower dividend yield and the higher dividend growth rate. Most of them do. That's significant enough to get above and beyond 10%. If you look at Lowe's, they're over 22% as far as the hurdle rate grows. T. Rowe Price, another one, over 20%. Sherwin-Williams, 17%. S&P Global, of course, they know the game, 17%. So you can take a look at this, and I got it broken out by sector, by industrials. Most of them are industrials, but financials as well, and a few consumer staples. Payout ratio. I can't express to you how important I'm thinking this is. VF Corp, their payout ratio was over 80%. And I have to think, without having looked deeper into this, that had been a contributing factor. But if you take a look at these companies that are in the 20 to 60% range, um, you know, uh, Archer Daniels Midland, 20%. And then you go down the list, T. Rowe Price, right under 60%. They're staying in that range. And this is a packed list, if you will. Now, there's a handful. There's six that are above and six that are below. Six that had payout ratios below 20%. Um, I would say take a look at, for instance, well, we talked about Roper Technologies, and Brown and Brown's another one. But look at Nucor, look at Albemarle. They have very low payout ratios. Um, but one thing that's interesting is look at the dividend, look at the hurdle. Okay, look at the last column, the dividend yield and the dividend growth rate. And look at this for Expeditors International and Roper's Technology. With their low payout ratio, they're clearing the hurdle. Expeditors International would be at 11%, and Roper would be at 12.34%. Brown and Brown has a fairly low payout ratio, and they're almost at 10%. So I feel good about that. The low payout ratio would not deter me in those cases. I might ask, can you increase your dividend, growth rate more and get the dividend yield up? But these are not bad. I would look at Nucor, though. They have a very low payout ratio, and and their hurdle rate is low. So I'd be wondering what's going on. Why is that so low? Are you reinvesting profits in new technological processes and methodologies? What's behind that? They're clearly uh, clearing their dividends commitments. Earnings per share is over 13. Dividend per share is 2. So that's a good metric, but it leads me to ask questions. So it's good to ask these questions. You always got to have good questions. And then there's six that have payout ratios greater than 60. Uh, I would say first and foremost, we would throw out the REITs because the payout ratio is not a valid metric for REITs. Um, and Con Edison, eh, you know what? I want to stick to the 60% rule, but I think that Con Edison is a good investment. But again, we got to do some deeper digging. I'd look closer at IBM. That payout ratio for them is a little bit high, and the hurdle is less than 8%. So I like the dividend yield. The dividend growth rate is low. I'm wondering if their yield is too high, and if they're going to run into trouble down the road. I don't know. And of course, I already mentioned Clorox and that high dividend payout ratio, which we need to investigate. And that, folks, is the end of our discussion of the aristocrats. So I hope you found this helpful. Again, it's my intention not to cover everything, but to highlight the important things and what is important when looking at dividend growth stocks. Um, I would ask if you would kindly like the video if you found it useful and subscribe to this channel. It would be a great help to our channel to keep it going. It's something I really am committed to and love to do. And feel free to share the video with a friend or a family member if you think they're going to find it useful. I wish you a very good day and take care.